tell.
Nope. Hey everybody, welcome to Martinis with Scott. We're starting half an hour late today, which is entirely my fault, more specifically my clients, but I won't blame them. Give people a chance to join if they want to join. We are episode 20 today. What financial tools are required to turn around a company and to get a troubled company refinanced? That's what we're going to discuss today. And for that, we brought in the Sinclair Range modeling guru, financial modeling guru, Olga.
Yeah, 5'4". This is the best I could
do. All right, let's bring this music down. Welcome, episode 20, Martinis with Scott. An in-depth conversation about winning at business, targeted to business owners, entrepreneurs, management. Coming to you live today from 20 Bay Street in Toronto. And I have myself and Ashley made Dylan's Martini. Thank you. It's Dylan's today, right?
It is Dylan's.
And you have your special Russian vodka.
Water, yeah.
Water.
That's that okay.
Da. Please subscribe. Martinis with Scott channel on YouTube. What else?
Just do one thing.
Apple Podcast.
Oh, Spotify.
Go and subscribe to the channel.
The camera's going back and forth. I got to reset it. That's why I learned to film camp. Ready? It should work because it needs to know what white is.
What
It calibrates the camera. You
really?
Put white in front of it, yeah. So it recognizes that this is white, and then it calibrates.
If you're listening on the podcast, Olga just disrupted the entire show with a piece of paper in front of the camera. Did it work?
Yeah, kind of.
You went to film school?
I did. I went to film camp. 2005, really? Yeah.
Okay. And then you wrote a play.
I did.
And produced a play.
I did. Toronto Fringe.
I like it.
And got into Toronto Fringe in the first try. People find that to be impressive because it's a lottery. Apparently people do it like year after year. And
it's a lottery?
It's a lottery.
So it wasn't based on your merits?
No, of course not.
Okay.
Yeah.
Fair enough.
If you had seen my play, you would agree.
We started way back in episode, 4, 5, 6, somewhere in there, a 10-part series on how to finance a troubled company. Mm-hmm. And we have a top 10 list of, tips for getting a financing done.
There's an order to them.
Yeah, in troubled companies. And we've been talking a lot lately about the Sinclair Range protocol for turning around a troubled company. And there's overlap between these lists. But what we're focused on today is the original 10-part series we went through. And just because it's been so long, I'm going to give you these top 10 tips again. So the number one is admit you're in trouble. We have just hammered this home all August on Can't Trust, a free and Can't Trust, a number of other, they're down to $1.70 or something right now.
Return all that stuff.
So we've been hammering home that point. Admit you're in trouble. Number two, identify the trouble and the people responsible. So the idea here is to convince your external and internal stakeholders that you're serious about this, that you want to make a change. And so to do that, you need to make change at the leadership level. Make a plan to fix the problem. So get at it as opposed to a plan to plan. And then we head into numbers 4 and 5, which is what we're going to tackle today. Prepare a written business plan with a monthly rolling multi-year model. And number 5 was prepare a 13-week cash flow. And I won't go over 6 through 10. We'll be covering those at a later date. But in prior episodes, as I said, like I'm reading from episode 6 right now, the top 10 is there. So you can go back, you can look them up. They're probably on the Sinclair Range website. If not, they will be in a minute, like in a day. So what we're going to focus on today are the financial tools that you would use both to turn around a company and to finance a troubled business. And the distinction there is, when you want to finance a troubled business, you actually have to turn around the company, so that there's a necessity there. But also you want to communicate to lenders and external stakeholders in a way that they understand, that they are used to, that communicates your message, and that is simple and concise and is a great tool for doing the turnaround as well. And so the answer to those things are 2 specific tools that we're going to talk about today. One is a rolling monthly model.
Yep.
And the second is a 13-week cash flow. Mm-hmm. Do we talk about daily cash flows?
We don't. We can touch up on that.
Okay.
As to why it's important. But those are our main ones. And maybe the daily cash flow does serve a purpose. But in very dire situations, which you might very well be
Okay.
in, and we'll touch upon that as well.
Okay, so I didn't do a proper introduction. Olga Jelani with Sinclair Range,
Mhm.
our VP and financial modeling Excel spreadsheet
Yeah.
guru. The two tools we're talking about today are Excel spreadsheets. I like to think I'm the best financial modeler going, but then the next generation comes along and
Yeah, thank you.
you know different tools.
Thank you.
They have different shortcuts. I don't even know what they are.
Yeah.
It's strange.
Like the format painter.
Yeah.
Changed your life.
It
Not
did.
the first time.
It really
Not the
did.
last.
There you go. All right, I'm going to turn this over to you.
Sure.
I may add some points in along the way, but mostly I'm just going to sit here and have my martini.
Makes sense.
Have at it.
That's the name. Financial modeling, I like to kind of open with the fact that in any business or in life in general, there are factors that you can control and there's ones you can't. So instead of stressing about what you cannot control, that's good. What you cannot control, you have to focus on what you can. So market dynamics, with how your competitors are acting, general economy, welfare, those are, as a single company, you can't control that, but you can control things internally. And the financial models that we're discussing today are the ones that help management make that distinction, which is hard enough to do as it is, as we've learned in practicality, and actually concentrate their efforts on the things that they can't control as opposed to just staying up at night trying to figure out what they can't. So we've said this before.
Is this a bit of the whataboutisms? I had a meeting about this today. So here's what we need to do to fix the thing, and the immediate reaction is, yeah, but that doesn't work in this example.
Yeah,
but that doesn't work in this example. Like, give me a break.
So we've actually seen pushback where smaller companies will say, well, this really, I've even asked for a sales projection from sales managers, and they say stuff like, well, it's nearly impossible for us to do a sales projection. And it's like, yeah, you're a $20 million a year company, but like Walmart does a sales projection, right? They're also predicting the future, but they do it. They do a budget. They have a benchmark. They have a standard. And if you're just shying away from it, that's a totally separate issue. I will touch up on that as well. But specifically for troubled companies, I think this series is called Financing a Troubled Company, but it's also very useful to be proactive. It's great proactive advice for startups and operating businesses who may not be in stress or may not be aware of it, to improve their operations and actually forge trust between stakeholders, lenders, investors before they actually have any problems. That's good. That's good to have in your bank, that trust, those brownie points.
When you get into the monthly model, one point that I think you might make, or I'll make it for you, is that you can really see a trend. It's not that useful month to month.
Yeah.
But 3 months out, 6 months out, 12 months out,
right,
you can start to see a trend, which I think is your point here. So even when you're not troubled, we run it on every single business.
Yes.
Monthly model, right? And you can see, maybe you're not going to be accurate in month 9, but your trend is going to be accurate.
100%. We had a business that was doing excellent in Waterloo, and we had the exact same steps. We updated the model, we evaluated it, we had discussions. Even good times or bad, you're doing the exact same things will keep you afloat. So financial models are especially important in restructuring and any subsequent financings for one simple reason. They support your plan, and they prevent you from throwing money aimlessly at a bad situation. Or in a more crude way, it prevents you from pissing away other people's money once your own funds are depleted, right? Nobody wants to just keep rolling with the punches and tossing money at a bad plan. And once you get in it with more sophisticated investors and lenders who maybe have more experience and friends and family who helped you along the way so far, or whoever did, you're going to encounter those roadblocks and those questions that you are almost impossible to answer without a proper financial model.
Right.
So you have to create a detailed outline for use of funds and instill trust in the lenders that the management team can do 2 things: understand the business strategy and execute it, and is committed to regularly and thoroughly evaluating their own financial performance as opposed to waiting for the lender to do it for them. Because when the lender comes in, and it's usually a lender or an investor, comes in and does it for you, it's going to be a lot more painful than you do it yourself. Be proactive and bring up those issues.
Right.
So for this reason, we always, without fail, build at least 2 models: the monthly rolling model and a 13-week cash flow. So let's start with a monthly rolling model. In our case, I've encountered this in different ways, just like a discounted cash flow, whatever else. But the way we do it, because we also act as operators, not just as bankers, we do a 3-statement model, which I actually had not seen until I met you. Balance sheet, income statement, or P&L, and cash flow. So,
and if I can interrupt for the accountants that are listening, it's not a cash flow. It's a statement of changes, but it's close enough. It reconciles and balances everything. We call it a cash flow. It drives the cash line on the balance sheet, but to be technical about it, it's a statement of changes.
Right. Exactly. Yeah. So don't just think of a model as an Excel spreadsheet you put together and all the things add up. By the way, I'm not going to be walking through a model because this will be like a 3-hour.
And boring.
I can make it fun. And we're not going to build the model. We will post one on the corresponding blog post on sinclairrange.com. Just a sample of an ABC code that's not related to anything. It'll be kind of an industrials company with.
Cool. Okay.
Yeah, and you can just use that as a template. And if you have any questions, you can email either one of us. So I always start with an income statement and work from the top down. So revenue to net income, all your sources of revenue, however many you have, and all your expenses, and you break out each one line by line. And you make sure that your model actually matches up to your annual reporting, so assuming that you have some sort of audited statements as well. But that's not vital.
A huge key to a monthly model is it's not a static document. You put in your historical actuals. Mm-hmm. So we always put in 3 years of
2 to 3 years,
depending on the deal, but 3 years of annual auditing. We have an annual tab, a monthly tab, and a assumptions tab. And sorry if I'm stealing your thunder here.
Ton of it.
Yeah. And but the point I just want to reinforce is that the model is useless if you don't put any historicals, your actual numbers, because that's how you learn whether your assumptions make sense and whether you're offside on your variances.
If you've never had 50% direct materials to revenue and you're projecting 20%, then something's
doesn't make
not,
any sense, right? So you got to put the actuals in, and because you're using this model to send to external parties like a lender, it has to tie to your audited statements.
Yep.
Therefore, you need to use your audited statement line items. Bottom line. You can, on the different layers, you can blow those out into more details. I'm just trying to reinforce your point that it needs to match your audited statements. Rarely from other consultants, firms, like companies with in-house guys that build these models, rarely do they tie to the audited statements. Imagine you're a lender.
Rarely or ever.
Yeah. Imagine you're a lender. You're going to ask for the audit statements because that's the external document you want to rely on. And then you get the financial projection, and these things just is like apples and oranges.
Precisely. So I'm going to get back to this, but all of these documents you present to a lender or an investor or even to your internal team actually work together. They're all just pieces that have to correlate because, I'll reiterate this, but your 13-week cash flow has to jive, and your assumptions have to jive with your monthly cash flow. Otherwise, you're just making different projections and you're just throwing stuff at the wall and seeing what sticks. So, and on top of that, it should also tie with the way you've set up your QuickBooks or whatever your software is.
Otherwise, you can't report the historical. Yeah. So you've got your actuals for the month. Yeah. But your actuals are completely different line items than your model. It's useless.
Precisely. And when someone comes in, like we do, we often have this where QuickBooks is completely different line items than what the annuals are. And it's on us to of try and reconcile what the auditors are doing. So as operators, we build these models so they can be updated with actual figures when the monthly statements become available. And yes, that actually means that somebody has to take these statements and manually enter them into the line items that they correspond with. So you can assess, like, this is what we said we'd do, and this is what we did.
Yeah.
So it's like, yes, this is a dynamic thing. You have to come back to it. You don't just put one together and put it on a shelf. And again, a lender or investor who's coming in to help you out will be aware of that as a requirement. As a standard. We didn't really come up with that. Yeah. And include and highlight your key performance indicators, the KPIs. We're not going to go into what these are, but we did do a blog post on it in an episode.
We did an episode on KPIs,
We did.
Right?
We did. Yeah. So you're about like identifying the problem and people causing it. And we'll put a link to that as well into the blog post on sinclairrange.com. But that's a way for management to get together and discuss what they did right and how to keep it up. Like maintenance is important, right? We've seen management teams hit certain benchmarks and then things fall off. Yeah. What they did wrong and why it didn't work out. So, and on top of that, do we need to adjust our outlook and how we'll impact our cash demands? So if you expected certain levels of performance last month, you didn't meet them, then clearly you will need a stronger cash injection going forward. And then we move on to the balance sheet. The balance sheet assumptions are largely driven by the components of your P&L and your policies, both internal and external. So how many days does it take for you to collect accounts receivable? That will technically just drive you. That's driven by your revenue line, and how many days you're getting your.
So you need to make this model as dynamic as you possibly can, right? So typing in hard-coded numbers on collections. So let's pick on receivables. So everybody's like, okay, well, collections drive this and that. So but that's not the answer. What you want to do is make it dynamic. And the way to make it dynamic is to say, okay, on average, I'm collecting receivables in 45 days. Okay. So my opening receivable was $100, and my closing receivable is driven by the 45-day assumption. And my sales are projected elsewhere. And so the only thing left of my collections, and that falls out. That, right? So that's what you do. Or you just do the closing line. You just do receivables 45 days. So it's equal to this month's sales and half of last month's sales. And that's it. Because if you build this whole thing dynamic with the balance sheet, income statement, a statement of changes, that drives the cash all by itself.
Precisely.
Right?
So it all has to be cohesive and reflective of what's actually going on in your company and what your plan actually is.
There you
go. Because anyone can really, I think like our role in this is not to just, sorry, it's so dry in here. Our role in this is not just to tell you, to walk you through an Excel.
Martini. It helps out.
Yeah, right. Might need something stronger. It's not just to teach you how to set up an Excel spreadsheet. It's actually how to use that in your day-to-day management of a company. Because it's easier to find a template for any of this online, but it's a different animal to understand how to use it and how to assess yourself and where to ask the questions. With AR, I mean, it's also important to track if you assume it's 45 days, but for the last 6 months it's been 60 days, then somebody has to go back and talk about accounts payable and accounts receivable and how we're actually going towards on collecting these things.
And the beauty of the model, if you build it right, if you have that 45-day assumption and 60-day reality, you can change your assumption to 60-day and see how quick you're going to go bankrupt. No, really, right? That's what.
And that's the point. How long?
And if you were doing that, 30 seconds later, I would have an answer that say, oh, you're running out of money 4 months from now.
Right.
If you're collecting in 60 days. Right.
And same thing with how many days are suppliers extending accounts payable to you, and should you renegotiate that? Are you paying faster than you're collecting? Then clearly you're not bridging that gap. What expenses have you prepaid and why? And what is your depreciation on your assets, which will obviously won't impact your cash, but it will impact your net income and any covenants you have on that. Last thing I'm going to say is balance sheets must balance, or else they're just shit.
Yes.
Yeah, that's an important one. It's a little highlight for you. But what really happens is all of this boils down to the cash flow statement.
That's not just sarcasm either.
Oh no, that's true. Yeah. I tell that to all
25%.
I've seen public company financials that haven't balanced, and I don't mean like, oh, the surrounding error of like $5. It's like, oh, it's like $30,000 off. It's like a junior mining company. Like, why couldn't you had like $100 million in financing? You couldn't hire.
That was the 30 grand was actually the CFO's salary.
Right, I was gonna say. Yeah, and who just like 10% time commitment. But all it boils down to cash flow, the cash flow statement, which you correctly pointed out, obviously, that is a derivative of the projected balance sheet income statements. And it's really just a statement of change to financial position.
You need to, if I can let the accountant talk here, you need to link these statements together. So your cash line on the balance sheet comes from your statement of changes.
Right. It's not just a hard-coded number.
Your retained earnings on the balance sheet comes from a formula of closing last period retained earnings plus your net income from your P&L this period equals your closing retained earnings. And that's a way to tie all these statements together.
Precisely.
To make sure that they balance. And that, here's the thing. if you sat down and tried to hard code out your cash flow, 100% of the time you're going to get it wrong.
Yeah. Or you're going to have the little adjustment line.
You're going to get it wrong, right? But if you focus on your cash flow being a derivative, as you put it like that, as a fallout from changes in the balance sheet, which is really what it is, you're going to get it right over time.
Yeah.
And that's what that model's all about.
Yeah. And on top of that, it's an internal control function because it reconciles your cash position on your balance sheet and your P&L. And will make sure that you're capturing specifically the net working capital. That's probably where most of the problems come from. That you're not aware of how long of your net working capital requirements. We should probably do either. Mental note. I don't know if we've ever done a quick shot on what net working capital means, because I think sometimes people don't know what that is. But that's a good idea. We should jot that down. And in terms of timelines, these models can range in terms of projection. We like to have 2 to 3 years of annuals in our models. So we can actually see how realistic our projections are if they go back, or how long it's been in trouble. You know what I mean? And then we'll do another 3 years of projections. Usually, but
if the turnaround happens in 3 years,
correct. But so the general rule, and that's for us, and the general rule is that your model timeline should align with a timeline you have in your business plan.
Right.
So again, you're communicating the exact same message. So we've kind of covered that, and again, we'll post a template of this. I think if you look at a template of what one looks like, you might want to rewatch this segment, and the visual representation. I'm not going to walk through it because it's just tedious and it's not value added, especially if you're on a podcast. Then there's a 13-week cash flow, which again, very important part of this is that it has to tie back to the monthly cash flow statement.
And it won't tie back exactly.
Of course not, because
it has to be directionally accurate.
Yeah.
If I can use a Trumpism too. Sorry.
That's what the internet needs, more Trumpisms.
Exactly. So the
sorry, I was gonna
while you recapture
yeah.
yourself, the monthly rolling model, to me, I don't think I'm necessarily going to be right next month, but I'm going to have a pretty good direction as to where this company's going 3, 6, 9, 12, 3 months, 3 years from now, right? Whereas the 13-week is intended to tell me how much money I have in the bank next week, right?
Yeah.
So it's a different tool.
They're
not going to reconcile exactly as a result, but they need to be. 13 weeks is 3 months.
You can't assume 60 days on your 13-week cash flow in terms of collection on sales, and you can't, and then assume 100%. 45 on your monthly model, right? Besides the monthly model, we include a 13-week cash flow, which is your 3 months, 1 quarter. That drives to the monthly cash flow. I'm going to repeat this over and over because we've seen a lot where you have one projection on one side and a different projection on the other, and by virtue, it goes along with all your operational projections. The monthly cash flows are required by these more sophisticated lenders that you probably approach in the turnaround restructuring plans. And it ties back to the repayment of debts, cash availability, and business valuations that require longer horizons offered by the 13-week cash flow. So how do you make one? And again, I'll include a sample of this one as well in the blog post that accompanies this episode. But the whole point is to illustrate cash receipts, like cash inflows versus cash outflows. And the cash outflow specifically of the company by category.
Excuse me.
It's okay. By category. So your suppliers, your HR, your administrative, what else do we have? Any tax payments, any utilities, rent, anything that has to do with occupancy, all that kind of stuff. Sorry. Okay. The water. So break those out by category, and if necessary, and I actually would recommend this, do it by supplier, because when you're in trouble,
Say that again.
Do it by supplier, not just by category, because when you're in trouble, a lot of the time that we encounter, thank you so much, that we encounter a company, our first move, and a lot of companies don't understand this, hint, hint, nudge, nudge. We go in and actually renegotiate the payment terms to kind of help stretch the available cash if possible. Contact accounts receivable departments of the suppliers and see if we can arrange a repayment schedule that's a lot more flexible than the terms that the company has expectations.
Here's an important point. If you're in financial difficulty and you can't pay everybody on credit terms, then you need to renegotiate, right? That's just the fact. And supplier negotiations should not be a negotiation. They should be math, right? You should just pay them the money you have. How do you know what money you have? You do a 13-week cash flow, right? So there should never be a circumstance where you're going to a supplier. I don't know, do you divide yours into A, B, C's, and D's like I do?
Yeah, I do mine with colors, but yeah.
Yeah, okay. Like the critical people, the people that you use but are so critical, the C's like you're never going to use again, and the D's are related party. Like we kind of go through this process. But you walk into, there should never be a scenario where you walk into a supplier and say, like, I'm going to pay you 100 cents on the dollar over 12 months or whatever. And they say, that's not good enough, do better. And you go, okay, let me negotiate, right? That shouldn't happen, because what you're offering is what you have according to the math of the situation. Okay, obviously there's rejigging and the priorities and that sort of stuff, but if you don't have a 13-week cash flow, you can't do that deal.
Yeah, I think maybe the overriding lesson in this exercise is prioritizing. Whether it's prioritizing what you focus on in terms of KPIs, versus prioritizing which suppliers you focus on, or prioritizing how your accounts receivable spends their time. So that it helps you it helps you understand, make the distinction of what's important, what's not, and of the things you can control and you can't. And within that category, what's the most important for you to control right now? Because there's still 24 hours in the day, right? Yeah. And a lot of the time I find that the energy level and the time constraints that are available to management are obviously limited and they've already spent. So we have to start prioritizing their own bandwidth. So with the 13-week cash flow, it actually answers for lenders and investors that are coming in is, can this troubled company keep head above water? And if so, for how long? And if it can't, how much cash does it need until it can get to that point, until it can, do all the things that we were talking about in the second episode in terms of, moving your around, hiring more, letting people go. Yeah. It needs to buy itself time. And how long can it survive for to actually go through a restructuring?
Yes.
So my last point, and this is a pretty big one, is that models are a tool to be used. Having said all this, as important as these models are, they can't be still documents. They're the larger funding package, your plan, your written plan, what you're saying to the lenders, because you obviously have direct communication. They have to be cohesive and they have to drive the same message and they have to have the same timeline. A lot of the time that we've encountered troubled companies that either don't have models, there's that pushback of like, we can't have one, we can't project it out. Or we find that their models do exist, but they're outdated, moldy, dusty, covered in cobwebs, just like put on a hazmat suit to access them, even though they're digital. They don't tie into the strategic plan at all. The model will have a 5-year resurrection of the business, and what they're actually what the management team is communicating to lenders is 3. So again, it goes back to building trust. If you're saying one thing on one piece and something completely different, you need 2 more years than another, that's not exactly forging any trust between a sophisticated lender and investor. We talked about that you're dealing with a different person who's lending to troubled companies rather than companies that are doing well, just starting out. And some of them actually show a projected decline in profit. So they plan to fail more.
Yes.
Without an explanation, or just continuously fail more year after year in their P&L and their cash flows. We've encountered where they've had, talented, talented, maybe like a sarcastic term, but it's not. Talented, directors of finance, and then you see their model and you're like, you lost $1 million this year and your projection is to lose 1.5 next year. And like, who wants to get in on that ship, right?
That's part of the range turnaround protocol is stop losing money today.
Right.
Today.
Yeah.
Not tomorrow.
That's our motto.
Yeah.
New business cards coming soon. And these do nothing to create this trust that I keep coming back to, because at the end of the day, it is trust. You're just human beings, and it's a matter of, do I trust you? Do I not? To go forward with it. What you should be doing with these models is regularly updating them. Again, someone has to do it. sit down every month, update those line items by line items, and reviewing the KPIs as a management team.
And use the variances
Yes.
to adjust your assumptions going forward.
We'll
We
get-
picked on receivables today.
We're-
If your assumption is 45 days,
the next topic is revising projections.
There you go,
Just
do it.
hang on.
all right.
So it's not a finger pointing exercise, but we pointed out it's clearly someone's fault. So if you sorry, well, no, not sorry. No one's sorry. By the way, if you're not sure what a KPI is, check out Martinis with Scott about step 2, which is to identify the problem. Quantitative results. We talked about feelings and how personal relationships play into running these companies or running them into the ground. And the quantitative results help remove those personal factors, those feelings from the evaluation of individuals and processes.
Yes.
So this is important, not just on like hard numbers, but also on the soft issues within the company. And they're not standalone documents. They're just a gateway to management discussions and an opportunity to reflect on quantitative results and share them with your stakeholders, specifically investors and lenders. The last point on this is revising projections. So very few restructuring scenarios go exactly as planned.
None.
From the beginning. But lenders who've been through this many more times than you have as an entrepreneur or management team, because they do this every day, they expect adjustments if they're done mindfully and they're done proactively, where the management team recognizes and potentially anticipates even months ahead that they have these hurdles and already comes with a plan to overcome them. That's just a show.
Give me an example of an adjustment.
Well, the AR.
Or maybe I can help you.
Go ahead.
So if you're doing a monthly model properly, what you're going to find is there are 4, 5, 6 key performance indicators that drive materially the whole thing, right? So there's going to be 3 or 4 that drive profit, and there's going to be another couple that drive cash flow on top of profit, right? Don't change those. Don't change those key performance indicators.
Yeah.
You can't go to your lender and say, you know what, I thought that my direct materials as a percentage of net revenue was really important, and now it's not.
That's one specifically probably won't apply. Yeah.
Sorry?
That one specifically probably won't apply.
Yeah, no, you can't. So you pick your KPIs and then you ride that horse. I'm not saying never change them if you're wrong, but for the most part, ride that horse. But if your assumption was 45 days on receivables collections, and you're doing 60 days on receivables collections, and you're running out of cash versus plan as a result, that's a conversation you can have with your lender, right? You can say, this is what we had, 45 days in the plan. We're doing 60. We've done a deep dive on this. Here's the reasons and how we're going to fix it. And it's going to take, 30 days to fix that problem. Yeah. Right? I just wanted to make that point.
Yeah, no, it's
Okay.
So it's just a competence illustrating opportunity. That's the difference between good management or decent management and great management, being able to anticipate problems with putting your experience forward and leading with that. And it shows that you also understand the company and the business, just basic business acumen.
But if you're the lender on the other side of that conversation and you've been preconditioned to know the 4 or 5 or 8, 6 KPIs, it just makes the discussion so much easier. Now you're not having a conversation about, I missed my plan. I'm off budget. I have a variance. Instead of that, you can talk about specifically how many days it took me to collect and why.
Yeah.
And how that impacts going forward.
And if you can do anything about it, maybe you can.
Right. That's a healthy conversation.
Yeah.
I'm out of money and I missed my budget. That's not a healthy conversation.
No, it also depends on who picks up the phone first.
Yeah.
So financial modeling may seem tedious. And again, I've seen a healthy share of feedback on this.
I thought it was fun.
For me, not for a lot of people. So believe it or not, and we have encountered instances where companies just believe it's unnecessary. So if you don't want to do it yourself, weird, but hire someone who does.
Yep.
We do it for someone within your company to do it. Maybe people just think it's more difficult than it really is. Once you learn it, once you build it, once you understand it, and once you understand how important it is.
You know why people think it's difficult is because
math is scary? Like,
no, because they don't know what they're doing. So you have to think about it and you have to try to create. Here's a really important point. Don't be creative.
Mhm.
Our tools, I've been using these tools for 30 years. I'm embarrassed to say.
been alive for that long.
They haven't changed very much, if at all. And I can tell you for a fact that this works with lenders and it works with stakeholders. They understand it. It doesn't leave them. It doesn't leave them asking a bunch more questions. It directs the conversation. How many times do you hear we have the best materials on the street?
All the time.
All the time.
All the time.
Right?
It's just storytelling, whether
Right.
it's at the Fringe Festival
All the time.
Yeah.
You don't change it. Just copy it. Steal it. Take it from us.
Yeah.
Use the format. Don't be creative. It's the creativity and the thinking, how am I going to do this? How am I going to do that? That makes this difficult.
Yeah.
Right? If you just forget all that, use the format that we have, focus on your own business and your KPIs, you're going to be fine.
100%. And I think the last point of this, I think we're keeping it short unless you have anything else to say, is that a lot of the time people are like, well, how am I supposed to keep track of my assumptions? I can't remember what I said and where.
Yeah.
It's very simple. Write them down. We our models always have an accompanying set of notes
In Word,
in Word
not in Excel.
explaining.
We don't
that,
have we have an assumptions tab, but we don't have like a what do people use, a dashboard tab?
Mhm.
They put in their assumptions in
Yep.
there and do
kind
go
of
look at
drives the
that.
model. We explain it in
In
sentences. Yeah.
In sentences.
And how many
That's right.
times in your life have you sent the CIM, the model, and the assumptions the written assumptions, and the lender has only read the written assumptions,
Yeah, all the time.
right?
Yeah.
Because then it's the
And
first.
how many times have you been sent somebody else's model with one of those dashboard assumption things, and the first thing going through your head is, okay, let me try and figure out how this spreadsheet works.
Right. Yeah, I've to anybody listening who's a future client, I'm probably not going to go through your model anymore. Like I just don't.
Yeah.
I pick up the phone and I'll actually walk through the assumptions. Like I'll
Exactly.
force you to write them out or just talk them out, but I'm not going to go through your model.
Yeah.
It's just a waste of time.
Okay, let me sum up with 2 points.
Please.
If you do your 13-week model properly, you're going to find within a few weeks, because you're going to put in your historicals, and then you're going to do revamp your projections, and you're going to find within a few weeks that you've got a pattern that repeats itself every 4 to 6 weeks, right? And it becomes super simple because every business has a pattern with some exceptions, but there's a pattern.
Very few exceptions. Yeah.
If you do your monthly model right, it's going to drive your KPIs for you.
Mhm.
If you didn't understand your KPIs going into the monthly model, you will by the time you're done your monthly model. They're going to be a limited number of KPIs. Be open-minded. And what you're going to find is, like I said, there's going to be 3 or 4 P&L, and there's going to be a couple balance sheet items that drive the entire business. Use those, make them better, use those as communication tools with your external stakeholders, your lenders that you're trying to get money from, your shareholders that you're trying to prove that you're turning around this business to, with regulators, suppliers that you're negotiating, and everybody.
Yeah.
That is your turnaround.
It's right there. It's all one unit.
Anything else?
That's it.
All right, let's wrap this puppy up. Thank you for joining us on Martinis with Scott. Somewhere I have a sign-off sheet. I can do this. Subscribe on YouTube, Martinis with Scott channel, Apple Podcasts, Spotify. Thank you so much, Olga.
Thank you.
Well done. I was
Thanks.
terrified. I was terrified of this segment.
Nothing to be scared of, just like modeling.
Exactly. Thank you, Ashley. I think we're done. That's what I want.
Cool.